So I said this before and I'll say it again, the UK is in trouble. And they have been in trouble since more than a year. I did a whole video on the LDIs, the pension funds that were about to go bust in the UK, how it could affect the banking sector, the private equity sector, and so on. Check it out on my channel. But this inflation, the higher inflation levels that the UK is seeing, especially in the core side of things, is not making the situation any better. Completely not. And it's making Bank of England's job way more difficult, because if they see higher inflation, they've got no choice but to hike further. And with the previous inflation report that came out from the UK, especially the core component, which made new highs, which reached to new levels, basically the bond market in the UK, especially the shorter end, started to price in that, hey, the Bank of England's probably going to hike rates all the way up to 6% or plus. And if this doesn't get better, then guess what? Those rates are going to go higher and higher and higher and higher, which is already creating such pain and problems in the mortgage industry. So there's definitely a mortgage crisis right now in the UK already. Imagine you hike rates even further, it's going to get way worse. People are feeling the pinch with inflation. They're feeling the pinch with higher food prices. They're feeling the pinch with higher mortgage costs. That and the landlords who are owning these properties and renting them out, they're just passing on that cost to the tenant. And at what point does this end? Right? At what point till, somebody blows up or something eventually happens? And we exactly almost had that in the UK. Now, before I begin and I get more into this UK inflation crisis that's happening, my name is Daniel. You're watching InfoVest. InfoVest is an organization that promotes financial literacy, teaches you about the macros, and we tie it in with stocks, bonds, commodities, currencies, and crypto. If you're interested in content like this, subscribe, hit the like button, and the bell icon to be notified on the next video. Now, let's get into it. A year ago, I did a video about the LDIs. I talked about the pension funds and most specifically the 30-year gilts. That's where the problems were. Now, when you look at the 30-year gilts and you look at those yields, since that huge blow up we had, those yields are back to reaching that same level where there was a crisis before. Basically going up 50% since that bottom and retracing 50%. So it's not so far from hitting those top levels, those high levels where there was a crisis before, about a year plus ago, right? The gilts were around 5+%, where the UK pension funds were going out telling Bank of England, signaling red flags that, hey, if you don't do anything, guess what? This is going to cause ripple effects for the whole UK economy, the banking sector. The banks were after Bank of England as well, say you need to do something to bring those yields down because we're going to go bust and the whole UK economy would go just under. And guess what? Lo and behold, a couple hours later, Bank of England came out and they bought a bunch of these gilts that caused those yields to come down. But we're seeing those yields come back up again, right? And Bank of England talking about more rate hikes. Now, we're not as high as where we were before. We're approaching that level. Now, if you look at the two-year yields, the two-year gilts, they've made new highs because of the higher rates, and higher rates should basically mean lower inflation. But if the future inflation reports, the UK inflation reports, continue to make all-time highs, continue to go higher, then you're going to see the UK bond market continue to sell off, those yields continue to rally higher, expectations of higher rates, and also causing probably the UK gilts to also follow along. Although the two-year gilt will be the leader, the 30-year will follow behind. The 30-year gilts will sell off in prices, and those yields will continue to go back up and maybe back to those levels where the crisis was before. And if it reaches to that level or higher, if there was a crisis already before, what would occur during that area, that level, if we break out higher? Now you could argue that, hey, Daniel, this situation is already solved. You know, they had time because Bank of England came, did a little bit of bond buying so they can adjust their portfolio and hedge better. Sure, that could be the case, definitely, which would maybe not cause anything. But definitely there are other firms out there, I wouldn't be surprised, who are not ready for this, who are not ready for higher rates. And maybe there might be some sort of event that comes from it. So if there was a crisis already around the 5% level in the UK 30-year gilt, and the UK 30-year gilt yield is right now around 4.4, 4.5%, another 0.5 or higher would make you think that there would be something that negative would come out of this. So very interesting. It would be very important to continue to monitor the UK's inflation because it will drive those yields, that bond market, which will continue to create more stress on the UK's economy. And if that continues to be so, then you could see some sort of big event, maybe a credit crunch or something, a black swan event maybe, that could come out from the UK. So monitor UK, monitor the pension funds, the private equity area, and UK's inflation and what the Bank of England continues to do, because I think there will be a lot of interesting signals and signs and maybe even red flags that could come out from just monitoring the UK's economy. So let me know what you guys think. Leave a comment below, subscribe, hit the like button and the bell icon to be notified on the next video, and I'll see you guys around.